Hey, Carrie. Yeah, there's a lot of sleazy stuff going on out in the world. But I'll tell you, there's a socioeconomic explanation for victimless crimes being legal or illegal at various times in the cycle. And the reason that guy running in Nevada might have a chance of winning is that when times get relatively hard, in other words, when the cycle turns down, which for a lot of people, that has already happened. You know, we're heading into Kondratiev winter and there'll be a big credit bust at some point in the not too distant future. And in times like that, we kind of give up and stop trying to control other people because we've got so much else to worry about. So drugs are legalized, which is happening all over the place right now. Canada just decided to legalize marijuana. So they became the first country to do that. And the same thing is true with other victimless crimes, quote unquote, like prostitution, where we think we can control stuff like that when we're feeling very confident, when things have been good for a long time. And when things start to get hard, we kind of give up. And so something like prostitution is very possibly going to follow in the footsteps of drug legalization as things get harder and harder. So, yeah, it's an interesting subject, interesting thing to watch as a kind of a coincident indicator of the situation in the economy.
Well, John, before I started this show, and by the way, our 7th anniversary was June 7th. I don't know how I forgot to mention that. June 7th, 2011. It's been 7 years. I've been doing this full time now. But before that, when the crash hit in 0809, my prediction was that within 10 years, marijuana would probably be legal, 5 to 10 years within the United States. I was about 20% right because, well, if you include the medical, I was almost half right. But the fact is, the legalization path is we're heading rapidly down that path. Trump just said that if the Gardner bill, he's the senator from the hemp state of Colorado, if it gets through Congress, he said he'll sign it. He's very much in favor of it. So that's what happens when you have these crashes. It's like, how much of society's resources do you want to dedicate towards prohibiting certain behavior that is questionably, it might be negative in the scheme of things, but it's not necessarily earth-shattering or of the magnitude that you need to bring the heavy fist of government enforcement down upon it.
Yeah. From a libertarian standpoint, the legalization of marijuana is a great trend because it's a sign that the government is getting out of the way and letting people own their own bodies. You can put what you want to into yourself, and then you accept the consequences of your actions. That's a more mature society that will work way better than having the government dictate what you can and can't do, and then hire a bunch of police to watch over you. That's the way things have been for a lot of American history, certainly for a lot of U.S. history. And it's nice to see us getting away from stuff like that. If you go back through the history of drugs in particular, one of the really shocking things about it is that the prohibition of a lot of drugs wasn't based on health concerns or even law enforcement concerns. It was basically just big, powerful interests like the liquor companies or the clothing makers who didn't want competition from something like marijuana or from even opiates and things like that. And so they got those things defined as a danger to society, and they were made illegal, but it was really basically just, industrial competition.
Yeah.
And it's going to be nice to see things like that as this trend extends beyond marijuana and beyond drugs in general. And we start getting out of the way and letting people make decisions about their own lives and then requiring people to accept the consequences of those decisions. I think that's just a good trend. In a world of a lot of bad trends, it's nice to be able to point to something that is positive out there. We have solar power, basically making fossil fuels obsolete. That's a really good thing. There's lots of breakthroughs in medicine now where they just cured somebody of incurable breast cancer with a new immunotherapy that promises to be able to be extended to other forms of cancer, it sounds like. So there's a lot of stuff going on out there that's really positive. If we would just get our financial act in order, you could almost say that the world is heading in the right direction. But we have to get through the financial crisis that's coming from all the stupid things we're doing before we can spend that much of our time looking at the great stuff that's happening out there.
Yeah, absolutely. Couldn't agree with you more. Well, there are bad things happening, like subprime credit, what you and I grew up calling junk bonds, junk credit, seems to be going more and more mainstream because the zest, the lust for added yield is causing investors at all levels of society to ignore risk. Risk is no longer getting priced into interest rates. It used to be, John, when you and I were growing up and you were a junk bond analyst, you were a credit analyst, the odds of a security defaulting in a certain amount of time were calculated into its price and therefore its rate of return. And the higher the odds were of default, the higher the rate you would receive. But now it's this belief that there's always somebody to bail out everybody, mainly the U.S. government, that is driving the rates on junk bonds lower and lower and driving them throughout society to share the risk.
Yeah, we've pushed interest rates down to unnaturally low levels to allow governments to manage their excessive debt loans. In other words, because of mistakes made in the past, we have to suffer under an artificially low interest rate regime. And one of the effects of that is to make everybody move further out on the risk spectrum, because that's where you can get yield. If you're a retiree and you need 6 or 7% on your savings in order to eat, and stay retired, you got to get that from somewhere, and you can't get it from a bank CD or a high grade bond fund or anything like that. So you move out to junk bonds, and because in the upward sloping part of a credit cycle, defaults on junk bonds are very modest because junk borrowers, in other words, non-credit-worthy borrowers, are able to borrow. So they can always refinance their debt. They don't default. And junk bonds look artificially safe because of that. One of the things that's happening right now that is amazing and a really good end of the cycle indicator is in subprime auto loan asset-backed bonds. In other words, Ford or GM or somebody like that will lend money to the buyer of one of their cars, even though that person isn't very creditworthy. There's not a high likelihood that they're going to be able to pay back that loan, but the car company gets the deal done. Then they take a bunch of those loans, package them up into bonds, and sell the bonds to hedge funds and pension funds and retirees. But those are not safe bonds. They just look safe because at this point in the credit cycle, people aren't defaulting at very high levels yet. And so what's happening in subprime auto loan junk bonds is that the sellers of those bonds are able to get away with selling lower and lower rated bonds. It used to be they had to be double B, which isn't very good to begin with, before anybody would buy them. Now there's single B, and lots of different originators are selling single B rated subprime auto loan junk bonds to pension funds that desperately need to make 7.5% returns in order to not get fired, the guys managing the pension funds, and hedge funds that are desperate to match at least the S&P 500, which most hedge funds have not been able to do lately. So they're buying these bonds with leverage, and then individuals, like I said, who need income in order to survive. And this is one of the places they can get it. Well, we're pushing all these people way out on the risk spectrum now in order to generate the yield that they need because of our own financial mismanagement. And eventually these things are going to blow up. And already it's starting. The default rate on auto loans bottomed out in 2013, more or less, and it's been trending up ever since. So at some point, people figure out that, more and more people are defaulting on their car loans. And that means these bonds probably aren't safe after all, and the bonds will sell off. And some of them will go bust. Mm-hmm. And that will spook the junk market, and the junk market will tank, which happens in every cycle. Always happens. And the fact that people are willing to buy the crazy kind of junk that only gets sold at the peak of a cycle means that we're probably close to the peak of the cycle. So a year from now, we'll be having a similar conversation, except that we won't be predicting that the junk bond market is going to tank. We will be chronicling its collapse. And the people who get hurt from it, this is something I repeat all the time, but it's always an important part of the story. The people who are hurt by this are by and large people who don't deserve to be hurt. The hedge funds, don't worry about them, but retirees and pension funds, these are people who they're not trying to take crazy risks. They're not out there speculating. They're just trying to generate a modest amount of income that they can use to cover the obligations that they've taken on because financial planners and everybody else told them that was the right amount of money to have, and that you should be able to generate 6 or 7% fairly safely. All this stuff was conventional wisdom when these people made the decisions that they made to put themselves in this position. And now they're stuck not being able to generate the income they need. So they're having to take these chances. And it's the government's fault. We mismanaged our finances for the past 30 or 40 years. And now we're hurting people who really don't deserve to be hurt. And a year from now, they are going to be crushed. We're going to see pension funds blowing up because the fixed income part of their portfolio is falling along with the equity part of their portfolio. And they can't even come close to covering the obligations to teachers and firefighters, et cetera, et cetera. And we're going to see retirees having to go back to work because that 7% return they thought they could get is really a negative 10% return for the past 2 years, and they really don't have enough money to keep their house or to relax, so they've got to go back to Walmart or someplace.
It's such a mistake because if they just stuck with a conventional investment for now, kept it in a CD or short-term treasuries, and instead they went back to work for 10, 15, 20 hours a week, all right, making an extra 10, 15,000 a year, that would more than make up for the yield, the increased yield that you're getting there, and it would dramatically up your safety. And look, 10, 15 hours a week of work is a positive. All the health professions have said the longer you work, the longer you live, the better you feel, the more useful you feel, the more socially engaged you are. So find another source of revenue. Don't up your tolerance for risk, because that's only going to come back to bite you, John, and we see it every cycle.
Well, see, the people who are doing it, at least a lot of retirees who are doing it, don't really understand that bond fund out there that's being sold to them by a financial planner and as being pretty safe, even though it yields, 6% in a world where 6% is a pretty rare yield, they don't understand because people are telling them it's okay. And recent history says it's okay. The default rate on those bonds is fairly low. And if you just look at the last few years' default rate, you think, okay, this is pretty safe. And look at that yield. This is cool. I don't have to go back to Walmart. I don't have to go back to work, Yeah. So people are being fooled by people who they should be able to trust into making mistakes like this. Mm-hmm. And it comes back to the fact that, goes directly back to the fact that we broke the final link between the dollar and gold in 1971. And ever since, governments have been borrowing huge amounts of money. And more recently, they've ramped up the borrowing. The U.S. doubled its national debt under George W. Bush. It doubled it again under Barack Obama, and it's on track to not double it, but increase it dramatically under Donald Trump. This kind of debt has to be managed. The government has to pay interest on it, in other words. So it's in the government's interest to push interest rates down so its interest costs don't blow up the budget. But in the process of doing that, it deprives everybody else, all the savers out there, of a reasonable yield and forces them to behave in really dangerous ways. Well, most savers don't understand this, but that's the way it's happening. And they're going to be hurt by it. And you know what? The government will get through this just fine, one way or another. They'll figure out a way so that today's politicians get to retire with nice pensions,
of course,
and still be called congressman or senator for the rest of their lives. They'll be fine. It's the regular people who are hurt by this kind of outrageous financial mismanagement, which kind of brings us back to gold, right? Because that's the thing that usually does really well in this kind of an environment. When governments artificially lower interest rates and aggressively devalue their currencies, historically gold and silver have been the things that people bought as protection against that process and profited from. Gold and silver went way up in local currency terms when governments are screwing up like this. It hasn't been happening lately. We're in a really, really boring stretch for precious metals right now. So I think a lot of people are wondering when that ends, when finally the new cycle kicks in and we start seeing regular increases in precious metals. And seasonality, at least, is working in precious metals' favor over the next few months. If you look at the history of gold and silver price movements, you see that they do languish in the summer because that's when nobody in Asia is thinking about buying gold and silver. Towards the end of the year, there are weddings coming up and the harvest is going to come in and people have more money in India and China and other parts of Asia. So they start buying again and that pushes prices up. So historically, between September and December is the time you want to start buying again. And that's not that far away. We can get through another few months of gold just sitting there if it does.
Yeah.
And know that there's going to be, just for cyclical or just for seasonal reasons, that there's going to be a nice few months at the end of that in which our little junior mining stocks double or triple and gold and silver themselves make nice gains. So we can look forward to that. And then the big cycle is probably going to kick in the not too distant future when we start heading upwards in a sustained way. And, just speaking for myself, not a moment too soon. This has been a really boring stretch.
Yeah,
I want
boring.
The bull market to kick back in.
Hey, well, according to Charles Nenner, at least short-term cycles for gold and silver are currently up, but neither of them has given off a buy signal yet. The buy signal for gold is 1307, 1308, and I'm just laughing. And the buy signal for silver, and we're talking daily closes, 1685. Silver right now is over. It's over 1690. We'll see where it closes today, but that could be the buy signal that we've been waiting for. These, according to the cycle guys, precious metals trade on a short-term 8-week cycle or so. So it's interesting, and we're just going to have to see. But I do agree with you that that we're heading for the seasonal peak of gold and silver. So even on a trading basis, not a bad place to be. But you're right. At some point, it's